$12 trillion. That is how much household wealth is now sitting on a hair trigger, waiting for the moment oil crosses $100 a barrel and the entire overbuilt, overcrowded, overvalued American stock market begins to collapse in earnest. As of today, March 9th, 2026, that trigger has been pulled. The S&P 500 just dropped to 6,660 points. Oil has crossed $100 a barrel for the first time in 18 months. The Dow Jones Industrial Average lost 3% in a single week. The Nasdaq fell 1.2%. And the Shiller CAPE ratio, the most reliable long-term valuation signal in market history, sits at 40. That is higher than the level that preceded the dot-com crash. It is higher than the level seen at the peak of the 2007 housing bubble. The only moment in recorded financial history when American stocks were valued higher than they are right now was in the year 2000, just before the Nasdaq lost 78% of its value in 2 years. Most people are watching the news and seeing a small daily decline. They are not seeing the mechanism. They are not seeing the chain reaction that historically follows every time oil prices cross triple digits. They are not reading the internal quantitative models that institutional money managers use behind closed doors. They are not calculating what happens when a market priced for perfection meets an oil shock that makes rate cuts politically impossible for the Federal Reserve. You are here. You are watching. And that means you are about to understand something the mainstream financial media will not tell you, because admitting it would collapse the consumer confidence that is the only thing holding this economy together right now. Before we break down exactly how this oil shock is about to pull $12 trillion out of American retirement accounts, savings accounts, and pension funds, please make sure you are subscribed to the channel and turn on the notification bell so you do not miss the daily updates as this crisis develops in real time. And comment down below, do you believe the Federal Reserve can still cut rates before a recession hits? Or is it already too late? Let me know in the comments, because the answer will determine everything about where markets go from here. To understand why $100 oil is not just an inconvenience at the gas pump, but a systemic financial wrecking ball, we have to go back through every recession of the last 50 years. Researchers at the Federal Reserve Bank of Cleveland have studied this correlation extensively. In every single instance, 1973, 1979, 1990, 2008, 2020, a major oil price spike preceded a recession within 12 to 18 months. Not sometimes, every single time. The mechanism is precise and mathematical. Oil is not just fuel for your car, it is the energy substrate of the entire productive economy. When oil crosses $100 per barrel, the cost of making almost every product, shipping every package, heating every office and factory, and powering every warehouse explodes simultaneously. This is not inflation in one sector. This is a structural tax levied on the entire economy, arriving all at once with no warning and no mercy. And unlike every previous oil shock, this one arrives against the most dangerously overvalued market backdrop in a generation. The Shiller CAPE ratio measures how expensive stocks are relative to their average earnings over the past decade. The long-term average is 17. Today it sits at 40. We are running at 235% of the historic norm. The Buffett indicator, total United States market capitalization divided by gross domestic product, stands at 219%. Warren Buffett himself has described readings above 200% as playing with fire. We are well above that level. When you combine a market at extreme valuations with a Federal Reserve that is trapped, a consumer that is maxed out on debt, and now a $100 oil supply shock arriving from an active war zone. You are not looking at a temporary pullback. You are looking at the ignition event of a cascading collapse. Quantitative analysts at Seeking Alpha now assign a 60% probability to a 20 to 30% wipeout in the S&P 500. 60%. That is 3 times the odds of a coin flip. For $12 trillion in American household wealth. That is not a forecast from a doom blog. That is a base case scenario published by institutional-grade financial analysts using the same quantitative frameworks that the largest pension funds use to manage trillions in assets. The fact that you have not heard about this on mainstream television tells you everything you need to know about whose interests those networks serve. Now let us go layer by layer through the mechanism. Because understanding this is the only way to protect yourself from what is coming. The first and most immediate transmission channel from oil to economic crisis is inflation. When oil crosses $100 per barrel, the cost of petrochemicals, plastics, synthetic fertilizers, aviation fuel, freight transportation, and residential utilities all rise simultaneously. Core personal consumption expenditure inflation, the Federal Reserve's preferred measure, was already running at 3% annually. That is 50% above the Fed's 2% target. With oil at $100 and trending higher, economists at Oxford Economics are projecting core inflation accelerating to 4.5% by mid-2026. Capital Economics is modeling a similar trajectory. This is not a small number. This is the inflation rate that makes every Social Security recipient, every fixed-income retiree, every hourly worker, and every saver structurally poorer year after year. Now here is the trap. The Federal Reserve cannot cut interest rates while inflation is running at 4.5%. Cutting rates when inflation is screaming above target is not monetary policy. It is economic malpractice. Every country in history that has tried it, Argentina, Turkey, Venezuela, Weimar Germany, has ended up with a currency crisis that was 10 times more destructive than the original problem. The Federal Reserve knows this. The markets know this. J.P. Morgan Global Research has already removed all rate cuts from their 2026 forecast. BlackRock, the world's largest asset manager with $11.5 trillion under management, has publicly said the Fed has limited room to act. The professional consensus is clear. Help is not coming from the central bank. But here is the other jaw of the trap. The Federal Reserve also cannot raise interest rates because the total amount of corporate debt, consumer debt, and government debt in the United States right now is so astronomically large that even marginally higher rates trigger a cascade of bankruptcies and defaults across every sector simultaneously. According to the Congressional Budget Office, the federal government is already spending $2.1 trillion per year just on interest payments. That is more than the entire national defense budget. Every quarter-point rise in the federal funds rate adds hundreds of billions more to that burden annually. The federal government is borrowing money to pay the interest on the money it already borrowed. This is the definition of a debt spiral. And raising rates accelerates the spiral toward its conclusion. This is what professional bond market analysts call the stagflation trap. The economy is stagnating. Gross domestic product growth is only 1.4% annually. Consumer confidence is at recession-level readings, and 72% of Americans in a February 2026 Pew Research survey said they view the economy negatively. But inflation is burning hot because of the oil shock. You cannot stimulate because of inflation. You cannot tighten because of debt. The only option left is to do nothing and watch the system slowly grind itself apart. The equity market has not yet priced this reality. The S&P 500 is down 1.19% today, down 3% on the week. This is not capitulation. This is not panic. This is the polite, orderly beginning of a repricing that, if the historical relationship between valuations and interest rates holds, has a very long way to go. Here is the math that the financial media will not run for you. Equity valuations are fundamentally a function of future earnings discounted by the risk-free rate. When the 10-year Treasury yield is stuck at 4.5% to 5% because the Fed cannot cut, and when earnings start compressing because every corporation's energy, transportation, and input costs are rising with oil, the price that rational investors will pay for every dollar of earnings must fall. At a CAPE of 40, investors are currently paying $40 for every dollar of long-run average earnings. At the historic norm of 17, they should be paying $17. The gap between 40 and 17 is the bubble, and bubbles do not deflate gently, they burst, fast, violently, with no warning for those who were not paying attention. But the stock market is just the most visible symptom. The deeper malignancy is spreading through every layer of the American financial system simultaneously, mostly out of sight, mostly unreported, mostly ignored, until it is far too late to act. Let us go to the second layer, the corporate debt wall. In 2020 and 2021, American corporations borrowed at historically low interest rates. They issued billions of dollars of bonds at 2%, 3%, and 4% annual interest because the Federal Reserve had suppressed rates to near zero as a pandemic emergency measure. Those bonds are now coming due for refinancing, not at 3%, at 7, 8, or 9% in the current environment. According to Seeking Alpha analysts who specifically modeled the maturity schedule of the United States corporate debt market, 2026 is the year when the first great wave of this cheap pandemic-era debt must be rolled over. The increase in annual interest costs for American corporations will run into the trillions of dollars in aggregate. That money must come from somewhere. It will come from layoffs, from reduced capital expenditure, from dividend cuts and share buyback suspensions, from exactly the kind of earnings compression that makes a 40 times CAPE ratio mathematically untenable. The cheap debt is gone, the foreign buyers are gone, and the bill is finally coming due. But here's where it gets worse. Because while corporations are facing their refinancing wall, the American consumer, the engine of a 70% consumption-driven economy, is already cracking under the weight of a debt burden that was already at the breaking point before oil crossed $100. The share of credit card holders who are 90 or more days past due on their payments just hit 12.7% in the fourth quarter of 2025. For context, the peak during the worst years of the 2008 financial crisis was 13.7%. We are within 1 percentage point of the worst consumer credit deterioration in modern American history. This is happening before the oil shock has fully filtered through to gasoline prices, heating bills, and grocery store shelves. When $100 oil fully transmits through the supply chain over the next 2 to 3 months, the consumer debt crisis does not plateau. It accelerates. A family with 2 cars in a mid-size American city will spend an additional $2,000 per year on fuel alone when oil is at $100 versus $70. That $2,000 does not exist in household budgets that are already carrying average credit card balances at 24% annual interest. It has to come from somewhere. It will come from reduced spending on everything else. Restaurants, retail, travel, entertainment, home improvement. The industries that employ the most people in service sector America are about to be starved of consumer spending at the exact moment their own operating costs are rising because of energy prices. This is not a recession risk. This is a recession blueprint. The only remaining question is how fast it unfolds. But the real danger that no one in the mainstream is discussing, the layer that connects everything together, is the commercial real estate catastrophe that is unfolding silently in the background while everyone is watching oil prices. More than $1 trillion in commercial real estate loans are due for refinancing in the next 2 years. These are loans on office buildings that are now worth 40 to 50% less than they were at peak values in 2019. These are loans on retail properties that were already struggling before the pandemic emptied the malls. These are loans on apartment complexes and mixed-use developments whose rent revenues cannot cover the cost of refinancing at current rates. 44% of all office building loans are already in a negative equity position. That means the outstanding debt on those properties is greater than what the properties are worth. In any other context, we would call this insolvency. In the extend and pretend world of commercial real estate banking, a strategy where banks allow borrowers to defer payments and restructure terms, hoping the problem eventually disappears. It is called managing the portfolio. The danger is where these loans are concentrated. Regional banks hold commercial real estate at 44% of their total assets. The large money center banks, J.P. Morgan, Bank of America, Citigroup, hold commercial real estate at just 6.5% of their assets. They have diversified revenue streams from investment banking, trading, credit cards, and international operations that insulate them. Regional banks have none of that insulation. Regional banks are pure commercial real estate plays at this point. And when the refinancing wall hits these loans, in a rising rate environment, with declining property values, with no policy relief coming from a trapped Federal Reserve, the losses will not stay on the balance sheet. They will become bank failures. The Federal Deposit Insurance Corporation currently holds $129 billion in its insurance fund. $129 billion against trillions in potentially non-performing commercial real estate loans. Against the $600 billion in unrealized losses already sitting on United States bank securities portfolios. Against the consumer credit deterioration hitting near-crisis levels. The math is not close. This is not a cushion. This is a formality. And here is what the Dodd-Frank Act, the financial reform legislation passed after the 2008 crisis, allows the government to do when a bank fails and the FDIC fund is insufficient. It is called a bail-in. Under a bail-in, your deposits above the insured limit of $250,000 are not protected by the government. They are converted into equity shares of the failing bank, worthless shares of an institution that is collapsing, in order to recapitalize it with your money. This is not a conspiracy theory. This is a provision of current United States federal law that has never been explained to the American public in plain language. The smart money knows this. Institutional investors, endowments, sovereign wealth funds, they are all reading the same data you are now being shown. They are positioning defensively. They are reducing equity exposure. They are shortening bond duration. They are moving toward physical assets. They are building their lifeboats while telling you through the financial media to stay on the ship and enjoy the buffet. Most people will be blindsided. They will see their portfolios decline 5% and wait for the Federal Reserve to announce rate cuts that will save everything. The rate cuts are not coming. By the time the central bank admits there is a crisis that requires an emergency response, inflation will already be at 4.5%, and the political cost of printing money will be unbearable. By the time they admit the problem, the window for protective action will have closed. The capital controls will already be under discussion in congressional committees. The bank holiday provisions will already be dusted off in Treasury Department drawers. You have the information that most Americans will not have until it is too late. What you do with it is your choice. But here is the plan that the data supports. Step 1. Do not wait for the Federal Reserve to signal the all clear. There is no all clear coming. The time to reduce your exposure to the most overvalued segments of the stock market is before a correction, not during one. Look at your 401k and your IRA allocations today. If you are 80 or 90% invested in equity index funds, consider whether that allocation makes sense when the market is trading at a CAPE of 40, the second highest valuation in recorded history, and a 60% probability of a 20 to 30% correction exists according to quantitative models. Rebalancing toward shorter duration assets is not a prediction. It is risk management. Step 2. Diversify your bank deposits across multiple institutions. If you have more than $250,000 in any single institution, and especially in any regional bank with heavy commercial real estate exposure, split those deposits to stay within the FDIC insurance limit at each bank. The FDIC publishes this advice on its own official website. At a moment when regional bank stress is the highest it has been since the savings and loan crisis of the 1980s, this is not paranoia. It is the minimum prudent action. Step 3. Eliminate high-interest variable rate debt. Credit card balances at 24% annual interest are the most financially destructive instrument in household finance. Every dollar you pay down on a 24% credit card gives you a guaranteed 24% return on that capital, a return no investment in this market can match with any certainty. Consumer credit delinquencies at 12.7% tell us that millions of American families are being crushed under this weight right now. Get ahead of the trend. Step 4. Consider physical hard assets as a hedge against the dual threat of inflation and banking system stress. Gold has historically been the strongest performer in stagflation environments. During the stagflation of the 1970s, gold rose from $35 per ounce to $850 per ounce, a 24 times return, while stocks and bonds both lost value in real terms. Physical gold, not a gold exchange-traded fund, not a futures contract, but actual metal in physical possession, has no counterparty. It cannot be bailed in. It cannot be frozen by a regulator. It cannot be devalued by a printing press. In a world where the Federal Reserve has lost control of both inflation and growth simultaneously, it is the one asset that needs no institution to guarantee its value. Step 5. Shorten the duration of your fixed income holdings. The traditional 60-40 portfolio, 60% stocks, 40% bonds, was built for a world where bonds rose when stocks fell, providing protection and balance. That inverse correlation has broken down in a stagflation environment. In 2022, both stocks and bonds fell simultaneously for the first time in decades, a preview of what stagflation does to the standard portfolio construction. Long-duration Treasury bonds lose value as yields rise. Short-term Treasury bills, 3-month and 6-month instruments available directly through treasurydirect.gov, give you safety and flexibility without duration risk. You earn a yield, you preserve your principal, and you retain the optionality to redeploy into better opportunities once the market clears. The storm is not approaching. It is here. The oil has crossed $100. The trigger has been pulled. The market is already moving lower. The Federal Reserve has no weapon left to stop the decline that is mathematically embedded in a cape of 40 combined with rising oil, rising debt costs, and a consumer that is one paycheck away from a credit crisis. Return of capital is now more important than return on capital. The bond vigilantes have returned. The cheap credit is gone. The foreign buyers are gone. And the bill, the multi-decade, multi-trillion-dollar bill for 40 years of debt-financed consumption and financial engineering, is finally coming due. They are not using missiles and tanks to bring down the American financial system. They are using oil prices, bond yields, and time. The weapons are invisible. The battlefield is your portfolio, your bank account, and your retirement savings. And the general public will not realize the war has been lost until the morning they check their account balance and find that the wealth they spent a lifetime accumulating has been quietly transferred to those who saw this coming. You have seen it coming. That is why you are here. That is worth more than any financial model. Subscribe to the channel and turn on the notification bell so you are alerted the moment the next development in this crisis breaks. We track the oil market, the Federal Reserve decisions, the bank stress indicators, and the corporate debt maturities every single day so that you have the information you need before the crowd realizes what is happening. Share this video with anyone you know who has retirement savings in an overexposed equity portfolio. You may not be able to stop the crisis, but you can make sure the people you care about are not the last ones standing outside the bank on Monday morning when the doors do not open. Together, we can navigate this collapse and emerge with our wealth and our freedom intact.